Good afternoon. I'm Pamela Hastings, and welcome to another Barometer Readings webcast. Joining me today, as always, is our Chief Investment Strategist and President, David Burrows. On today's webcast, we will be pleased to provide you a brief macro overview, followed by an opportunity for David to address your questions. So don't be shy. Email me at phastings@barometercapital.ca or hit me up on the chat link or the Q&A in Zoom. And with that, I turn the conversation over to David Burrows. Good afternoon, David.
Good afternoon, folks. It's Dave Burrows, and I want to welcome you to another Barometer Readings webcast every week, Tuesday at 4 p.m. I thought I had Pamela on with me today, but it doesn't look like she's joined. So why don't we get going? It's obviously been a big week for markets. Lots going on. It started with the inflation print last week, which clearly spooked the market and initiated a new sort of wave of selling. And so what we're going to do today is we're going to take it sort of from the top down and take a look at what's going on, take a look at what's been most impacted, what's holding up better, what's holding up worse, and try and define, where things can kind of go from here. And then I'll talk a little bit about what we've been doing in portfolios. So just quickly to start, we have been of the belief that we are in a structural bull market. This started in 2013, and there have been some sharp corrections along the way, but they happen in bull markets, and they tend to be quite different than those that happen in structural bear markets. So at this point, our belief has been that we're in a structural bull market. This is the correction to date, starting in beginning of January 2022, about 5 months ago. Here we are now in the middle of June. The S&P is off top to bottom, a total of about 23%. So we're going to examine that in a moment. We're going to take a look at rates. We've been of the belief that rates ended a structural decline back in 2020 at the lows in March, and that we were in the process of reversing a generation of falling interest rates. Last week, when we were on the call, we talked about the fact that we'd seen China's 10-year rates break the downtrend. We talked over the last few weeks about how the 10-year yield for US Treasury bonds had broken this long-term downtrend that started back in the early 1980s. And then in this past week, in fact, yesterday, we took out the high yield from 2019 prior to the pandemic, just to put the sort of final nail in the coffin of that, generation of falling interest rates. So very clearly, we have gone through a regime change. And we've talked about over the last few weeks, one of the things the market does not like is, quick movements in asset prices in either direction that cause them to question their beliefs. And I think what we've seen over the last week is a whole new group of investors who are clearly questioning their beliefs in the things that do well during falling long-term rates. The aggregate bond index we talked about last week was down 15% on the year, the worst year on record. When we take a look at the 10-year Treasury bond total returns from 1928 to present, this includes the coupon payments that you receive on top of the price movement. So far, year to date, 12.8% as of Monday, minus 12.8% registers as the single worst year for 10-year Treasury bonds since 1928. So we've talked for quite some time about the fact that bond investors tend to be a more risk-averse crowd. This clearly is rattling many investors and causing them to pull in their horns. When we look at all the different types of fixed income vehicles, floating rate, short duration, leveraged loans, municipal bonds, midterm Treasury bonds, mortgage-backed securities, you can see across the board negative returns for all interest rate bearing vehicles. So the only area that has avoided negative returns are Treasury bills. It's really one of the only places that we have any income exposure. In a short course, we're doing that to hold some dry powder for better markets. We talked last week about the fact that after consolidating 2-year yields in Canada had taken off and made new highs. Australian was in the process of doing it. Germany's bonds had done it. And now this week, US 2-year treasury bonds, same thing, had a sharp move higher following the inflation print that took them beyond the highs from 2019. So this reopens the wound that people have been feeling as rates have been going higher. And of course, the concern is, will this choke off the economy? Will we wind up in a recession? Will it have ripple effects into things like real estate and other assets that benefit from falling rates? Now, I can't stress this enough. There is a generation of people who got used to making money in certain types of assets that were benefited by falling interest rates. We've been making the case now for 2 years that we need to be focusing on assets that benefit in an inflationary world. Now, there's always going to be short-term pullbacks in those assets if investors as a whole get concerned about the economy. But the net of it is, we think that these are where the inexpensive assets lie, those that can be revalued over the next generation as we see a reflationary environment. As it stands right now, based on Fed fund futures, the expectation that's now been baked into the market is that the Fed funds rate will be at 4% in June of 2023, 1 year from now. So look at the change that's taken place in the first 6 months of this year. From 1% to 4%, or a quadrupling of short-term rates. So that clearly has an impact on people who are thinking about taking a mortgage, or companies that have significant corporate debt. So this causes us to really have to take a look at credit quality. We have to really look at a business's ability to absorb higher rates. And ultimately, we've been trying to find investments that actually benefit from an inflationary environment. So one of the things that's impacted by that sharp run higher in rates last week, this is the US dollar. So this is the US dollar against a basket of world currencies. And you can see when we go back over the last few years that clearly US dollar has been firming because the US economy has been stronger than other global economies. And the Fed has made it very clear that they plan to be quite hawkish going forward. In fact, we think that that inflation print increased the odds or the possibilities that the Fed in tomorrow's meeting might hike 75 basis points. Now, one of the concerns that the market has is that the Fed is behind the curve. They printed all this money, giving away, and the fiscal policy giving away benefits. The money in the system has exploded. Now they have to pull in their horns. They have to start to undo some of the quantitative easing. And that could have an impact on the things that require easy money. So the US dollar firming up over the past few days and making new highs is significant because it does have an impact on certain types of assets. And again, is seen as a barometer for risk taking. When we look at how the US dollar is done versus all world currencies, you can see Canadian dollar has been about the best currency year to date, which is why we've been hedging all of our exposure back to Canadian dollars in all the pools and the funds that we manage. Our view is that ultimately we're in the environment where a lot of different parts of our economy really benefit, specifically energy and basic materials. Okay, so let's look at the S&P. On the back of those sharply rising rates, and on the back of a strong US dollar, which ultimately hurts multinationals who have earnings overseas, the S&P, after rallying over the last couple of weeks, broke and made a lower low. In fact, 3 days was a little over a 10% drop. And that's not insignificant. Lots of people concerned yesterday as we made that number minus 22%. Now, again, this is a market that is not all homogenous. There are sectors that have really been hurt and sectors that have done quite a lot better. And we're going to go through that in a few minutes. But the S&P as a whole has corrected about what would be typical in a structural bull market if you were to have a recession. Now, of course, if you got a really bad credit-driven recession, like the one in 2008-9, it would get a lot worse. As it stands right now, consumers have been in pretty good shape. And we don't think that there is the same kind of stress in the system at this point that's likely to turn into a credit problem. But that's something that we have to keep our eyes open to. Now, the weakest part of the market has been the NASDAQ. And this is the NASDAQ composite, down 33% from the beginning of the year, actually from November. And we talked last week about the fact that while it had been bouncing, it did not qualify in our world for new positions because the relative price performance versus the S&P has been consistently weakening over the last number of months. And again, this week, underperformed the S&P 500. Let's talk about commodities for a minute. Commodities have been relatively outperforming now for the last 18 months, and they continue to. This is the Rogers Commodity Index. This is an asset that benefits from inflation or reflation. The equally weighted basket of commodities, as measured by the Rogers Commodity Index, has been falling for many, many years while we went through falling rate environment and disinflation. This changed early in 2020, early spring, when the money printing really got underway during COVID, and has consistently been making higher highs month by month. And this month is no exception. Now, it's not to say that if the Fed gets particularly tight with monetary policy, that they can't choke off investor appetite, or if they put the economy into recession, that demand could dry up for some commodities. But the fact is we continue to have structural deficits in many of the most important ones, especially oil. Now, this is the short-term picture. We continue to be in the Rogers Commodity Index above the 50-day moving average. We have pulled back a little bit over the course of the last week, but well above the 150 and 200-day moving averages. Let's talk about the most important asset in this group, oil. This is the ETF that measures Brent oil. And you can see we made just yesterday a new relative strength high versus the S&P. This continues to be exceedingly resilient, of course, possibly being supported by the conflict going on between Ukraine and Russia. But we had rising oil prices way before we had an issue going on in the Ukraine. And structurally, the industry's been very slow at bumping up its production. And it appears that the Middle East probably does not have a lot of the excess oil to pump. Now, we look at all of the reasons why things may be happening, but the most important thing to understand is what is happening. You have to have process. As most people know, we got three pieces to our process. The first thing is we take all of the investable areas of the market that we could focus on, and we try to identify those areas that are showing improvement or expanding breadth, areas of leadership. And for the last 18 months, that's been energy, it's been basic materials. At some points, it's been financials, it's been dividend payers. And there have been some areas that have not had relative strength and haven't had improving breadth. And those have been things like technology, communications, what am I forgetting? Well, we'll get there. But there have been some very clear leadership. The security selection is always about finding securities that are good getting better, where we can see based on the numbers that their financial condition is improving and in fact accelerating. But we also need to see price doing what we would expect given what we think we know. If price is not performing the way that it should, given what the fundamentals support, my guess is that somebody believes something's changing and we may be missing it. So the third piece of our process is the most important, and that is a very disciplined selling process. We can make the best investments we could make with the information that we have at time, but if the information changes, we have to be prepared to make changes in our portfolio. So market risk models to say, do we put new money to work if things are improving? Fine. Which areas of the market are we going to focus on? And that way we address the sources of return in the portfolio. Our job is to do three things. Focus the portfolios in areas of market leadership, where there's clear relative price performance and clear expansion in breadth. where we have a tailwind and the asset can be revalued versus the rest of the market. The second job is to recognize change, and there will always be change. Things that are getting better and things that are getting worse, so that we can constantly be bumping the weightings and the holdings in the portfolios to make sure that they are in tune with what's going on right now. And then there's some times where we have to be prepared to play defense. That means sitting on our hands. That means being a little bit more cautious. Our job is to be tactical. Now, a week ago, our short-term models were all positive. And we have to take those for what they are. Improvement in the percent of stocks above the 50-day, percent of stocks with positive momentum improving, percent of stocks making new highs versus new lows improving, percent of stocks paying above their 150-day moving average improving. And we saw that at the market level for the US market and for the world. Well, here's where we sit today. 3 very sharp down days that were broad-based selling across almost all sectors, driven by that hot inflation data that came, that drove short-term and long-term rates higher, drove the US dollar higher, and spooked many of the investors who may be positioned in the wrong spots. So what does that all mean? Well, it means there was a lot of selling. On Monday, 98% of all of the companies in the S&P were down on the day. That's about as bad as you ever see. We know that the average stock in the S&P is now down about 30%. So that means that some that are heavily weighted have done a little bit better. Some have done a little worse, but the average company's down a long way. We know volatility did tick up last week. So volatility yesterday spiked to just above 34, which is where it closed. Still below the volatility levels we saw in May, still below the volatility levels we saw in March and April, and still below the volatility levels we saw in February. So we've yet to make a new high in volatility. We'll have to see whether that comes. This certainly causes us to sit up and take notice. It's not how we make our decisions, but certainly we're watching volatility closely. Our job is to use breadth as our advantage. Where we see expanding breadth, that means money's getting put to work in a sector or a theme or an asset class. We want to add in those areas. When we see deterioration in breadth, our job is to do 2 things. One is to reduce our tolerance for risk, to reduce the number of positions that we have, to tighten up the stop losses that we have close to the current market price. To the extent we get stopped out, the money goes to the sideline and sits and waits. So when we have a few days like we had last week where it turned all of the breadth models down, that means we have to be less tolerant with risk. We have to use tighter stops. We have to reduce our positions, and we don't put on new ones. So let's talk about leadership and what got affected the most and what got affected the least. Well, clearly, on the back of very strong energy prices, energy has continued to have a pretty strong bid. We talked last week about the fact that inventories are exceedingly low and not getting better. When we look at the XEG index, which is the Canadian Capped Energy Index, it was down over the course of the week, but still trading at the 21-day moving average and above the 50-day moving average. It made a new relative strength high only yesterday. And while yes, if the Fed gets tight enough and chokes off demand, ultimately this could be a sector that does pull back. But as it sits right now, it continues to meet our tests. Now, energy is infrastructure like pipelines and transportation companies and service companies. There's lots of exposure in different areas, but this is something that we know that structurally we are in shortage on. The XOP, which is the US Producers Index, also made a relative strength new high in the last 3 days. And yes, pulled back to the 21-day moving average as well. The materials sector. Materials did pull back over the last week. A small reduction in relative price strength, still trading better than 89% of companies in the S&P for the year. But we pulled back in some cases, some areas below the 200-day moving average. That's something that causes us to have to be prepared to make changes. The XME pulled back to support. That's the metals miners. That's fine. The forestry companies, however, were worse. So last week, we reduced our exposure to lumber on Thursday and Friday. And we don't hold it this week, but it's continued to weaken and right now does not qualify to be part of our portfolios. Dividend growth stocks also pulled back. They maintain their relative strength versus the S&P, but again, some broke down, caused us to reduce some positioning. On a relative basis, though, they've been outperforming over the last year, and this is a group that we think will continue to perform well because it's got defensive characteristics. They've got growing dividends, which look really attractive in rising rates. Let's talk about putting those two together. The GUNR, interestingly enough, was basically at relative strength highs yesterday and still above the 200-day moving average. We think this continues to be an attractive area. Dividend paying commodity producers. The insurance stocks actually made a new relative strength high today. So certainly pulling back with the market, some of them with some damage. We think that the earnings growth is substantial and they have the wherewithal to relatively be re-rated versus the rest of the market, which we can see has been happening, but we also take that seriously. The defense stocks, which also have had very strong relative performance, certainly pulled back with the market in the last week, but again, 2 days ago made a relative strength new high versus the market. So some positives and some negatives. Let's look at the groups that have been weak. Well, they continue to weaken. The XLK is the ETF that represents the large cap technology stocks. Have been falling from a relative perspective since the beginning of the year. We noted last week that the bump up in price did not change the picture because relative strength really wasn't picking up. Relative weakness continued this week. The consumer, well, clearly at risk with rising rates. Consumer discretionary purchases can pull back. We know that auto demand has been very, very strong. We know housing demand has been very, very strong. We know retailers have done well. We know travel and leisure have had a big bump up in demand. But clearly the market senses risk to the consumer spending habits. Relative strength continuing to be weakening. Communications, which includes companies like Netflix and Google, made relative strength new lows in the past week. Now let's talk themes. Value certainly pulled back this week, but again, relative strength appears to be intact versus the S&P as a whole. The S&P growth index, however, again, continues to be very weak. So last week we put up this slide and it showed how over the last few months, the S&P growth index has considerably underperformed the S&P value index. So I got a question last week as to why. We also noticed that the Canadian market was relatively outperforming the S&P over the last year. And again, this week made another relative strength new high. Well, there's a couple of reasons for that. First of all, the TSX relative to the S&P has been sharply improving since December, probably because of some of the sectors exposures that we have in the Canadian market. Even though during that, the PE, the forward-looking price earnings multiple for the average stock, has been pulling back. Now, it's not because the price of the index has pulled back a lot, even though it's pulled back small. It's that earnings expectations for Canadian stocks are actually sharply improving, especially, of course, in energy and basic materials. But where it puts the forward multiple for the market is at the very low end of the range that it's been in over the last 15 years. That probably means that TSX has less risk than what we might see in the S&P. And in fact, forward earnings, very strong growth for the TSX. We talked last week about the Europe acting a little bit better, despite the fact that there is risk from what's going on in Russia. And the S&P continues to have improving forward earnings expectations, but at a slower pace. One of the reasons why we focus so handily in Toronto. When we look at the S&P earnings multiple, certainly the market pullback has pulled the PE multiple down from the low 23% range to 15, which puts it in line with the last few years. The only thing probably that adds risk to that is that it's been a while since we saw inflation numbers where we have seen them, and PE multiples tend to be lower during a more inflationary period because growth stocks underperform. So just to put a point on all that, this is the PE of the average growth stock, which is trading at a premium to where the average is. And inflation beneficiaries, which tend to be more value driven, are trading at a significant discount to the average. This supports the idea that value or inflation-oriented companies that are seeing sharp increases in their earnings estimates are actually trading at very low valuations relative to growth stocks. We think this differential can be squeezed out over time, either through outperformance in a down market or outperformance in an up market. But clearly we have an inflationary issue, and these companies have the ability to set price, companies that produce metals, companies that produce energy. So look, it's been a difficult week. Things that we did, we increased our cash weight. We increased the amount of money we have in short-term government instruments. Just put that powder on the sideline. We did reduce our position in energy slightly. We reduced our materials holdings slightly. We took down our financials weight, which is unfortunate because we just put some financial positions on, and we reduced our industrials. We are not looking to add new positions right now, given the fact that breadth readings are weakening. Now, in fact, these numbers were from yesterday morning, and during yesterday's trade, we took some additional positions off. We'll quantify those for you next week, but our exposure this week is fairly significantly less than it was last week. In our macro portfolio, we took off a full third of all of our long positions. Our short positions in fixed income were useful, and while everything pulled back, we think that the positions that we have are worth having. So look, it's been a really difficult year for a lot of investors. We're really happy with how our portfolios have held up. If you had a portfolio that had the S&P for 60% of the portfolio and 40% of the portfolio was in bonds, a very conservative mix, it's been the worst year since 1928. Sorry, since 1931 for a total return 60-40 portfolio. I'm sorry, 1937 was worse. I think that we're in a very different environment than that. So we're pretty happy with the fact that we haven't been caught with fixed income. We're pretty happy with the fact that we've been able to avoid a lot of the growth-oriented names. We have to continue to navigate this step by step. You know, we've shown a history over time that we're willing to get defensive when our models start to get defensive, and we're going to continue that process going forward. So this week is going to be important. Tomorrow, the Fed is going to make a decision as to what the rate hike will be. Will it be 50 basis points or will it be 75? Frankly, because the world is concerned that the Fed is behind the curve, 75 basis points might not be such a bad thing. But the market clearly has been positioning leading up to the Fed, and the Fed will give us more clarity as to what they're thinking going forward. And based on that, and based on how the markets react, we will continue to move step by step. So with that, if Pamela is there.
Yes, David, I'm back. Of course. So we have our first question from Lawrence. Lawrence wants David to provide the viewers with an idea of what kind of tools Barometer uses to hedge back to Canadian dollars.
Oh, well, that's a very simple one. In the pools and the funds that we manage, we tend to use currency forwards. So we will take the amount of US dollar exposure or foreign exposure that we have, and using forward markets, hedge out that amount back to Canadian dollars. We have used futures in the past, but we find that forwards are the most economical way.
Thank you so much, David. The next question comes from Larry. It's focused on heavy energy stocks. He asks, David, could you please comment on the LNG fire at the plant in the US and its effect on natural gas prices? Does it change your view towards gas-heavy energy stocks? Do you think it's mostly or at all priced in at this point?
Yeah, I think that this is a fairly sort of more of a short-term issue. It is structural in that, you have to be able to get natural gas out for to be able to use up that supply. And clearly there is a lot of optimism around the idea that the US could become a fair-sized exporter of liquefied natural gas. And we're going to have to continue to see infrastructure get built. So there was a short-term impact on gas prices. It may persist for the near term, but longer term picture continues to be very attractive.
Thank you so much, David. Let's see if we have any others. Nope, that concludes the questions we've received so far this afternoon. So with that, David, I'll leave it to you for the final word.
Yeah, look, I'll leave it with this sentence that's been on our screen, in all of these meetings that we've been doing over the last 2 years. When things get difficult, we have to just really focus on being a good seller. And we don't know whether this is a weak market that will continue. My guess is that we are a long way through this pullback, and we probably can get a pretty good relief rally as the market and investors start to get a sense for what the Fed is thinking. But that's an opinion. If we see our breadth models turn back higher, we'll look at adding positions back. But in the near term, our job is to play defense. Number one job is not to lose the money. So we're going to look for new relative outperformance in certain groups and be prepared with a farm team of things that we'd like to own if this market can get righted. But in the near term, our job is to be defensive, and we hope that this is useful to our clients. Thanks very much, Pam, and thanks everybody for tuning in. And we'll be back next week, probably with a clearer view than we are having today. And we wish everybody a good week. Thanks so much.